Well, at the center of the Federal Reserve's rate hike decision is a bank crisis that grows from the Fed's own actions. During Wednesday's press conference, Jerome Powell sought to distance the broader banking system from Silicon Valley Bank.
So at a basic level, Silicon Valley Bank management failed badly. They grew the bank very quickly. They exposed the bank to significant liquidity risk and interest rate risk, didn't hedge that risk. We now know that supervisors saw these risks and intervened. We know that the public saw all this. We know that SVB experienced an unprecedentedly rapid and massive bank run. So this is a very large group of connected depositors, concentrated group of connected depositors, in a very, very fast run, faster than the historical record.
So basically, Powell is saying this was an idiosyncratic situation. It was the fault of the bank's management. But some others are saying, guess what? It's the Fed's fault. Marvin Barth is one of those. He's Thematic Markets Founder, and he wrote at some length about this. And of course, this is a bigger picture, right, Marvin? That the sort of ultra low rates, quantitative easing led to the conditions that then created what happened at Silicon Valley Bank. As concisely and clearly as you can you make that case for us?
Yeah, I mean, it's important to remember that whenever an institution fails, it's due to a multitude of sources. And Chairman Powell is not wrong. There were clear risk management failures at Silicon Valley Bank. But let's remember that we're seeing significant losses across the board. This is what market concerns are about right now, is what other banks might be there. I think Silicon Valley Bank was the weak link, but the broader losses are associated with security losses from banks taking too much interest rate risk. What that means is that they took much more long-dated securities on board to their balance sheet, didn't hedge those appropriately, and they're suffering losses on those as interest rates go up. Now, interest rates go up all the time. We haven't seen them in the last decade or so, but in previous cycles we didn't see this kind of across the board losses. What was different this time? This time we had a decade of the Federal Reserve forcing banks to take more reserves on balance sheet. That's what QE was. Buy bonds in exchange for reserves. Reserves are money banks can't get rid of. They can't use, they can't give it to us. It is stuck on their balance sheet, which lowers their profitability and forces them to go take more risk. And at the same time, was telling them, you should go take more interest rate risk. You should move out the yield curve, buy longer maturity bonds. That was the express desire of the Fed. They actually said that very directly, and that's what they expected QE to do. And so these losses are absolutely directly attributable to Federal Reserve policy in the past.
And so even with that, Marvin, do you believe that on the front of long-term securities that there is more exposure that is in the system? And if so, to what comparison is it elevated among cycles past?
Okay, so I actually think that at this point, this is a tempest in the teapot. So I've just spent a moment criticizing my former colleagues at the Fed. Now let me tell you what an excellent job they've done. The term lending facility that they've created really does solve this problem. Because think about it. What's happened is most of these losses are in the bank's hold to maturity books. Those are books that are under accrual accounting. And as long as you don't have to sell them off, they actually mature at par and you take no losses whatsoever. It's only if you have to sell them when their values are depressed before they mature. And what the term lending facility does is it allows them to access liquidity if you do have depositor flight, right? So I actually think this crisis is now overblown. We've seen the weak links taken out. The rest of the banking system, while it could have suffered greater losses had they not put this term lending facility in place, they've done that. We're in a much better position. And that's why I actually think yesterday's market reaction to the Fed was completely off base, totally wrong direction.
Well, and I, it's interesting that you say this because I sort of read not only the statement, but also the commentary from Jay Powell, including the sound that we just played where he sort of laid the blame at the bank itself as sort of saying, like, guys, this is not a big deal, or at least it's not a systemic risk and there's not this bigger risk of contagion. Do you think is there still a risk of a bigger ripple effect in the wake of SVB's collapse?
Not in the U.S. Okay, so I really do think if you look at what banks did, and you can see this very clearly in the data. As the Fed pursued QE, particularly this last round of QE associated with COVID, banks did take a lot more securities on board. Banks did extend the maturity profile. You can tell that by how much they pushed onto their hold to maturity books. All of that is the sort of heart of U.S. banking problems. And as I just explained, term funding takes care of that. We don't have to worry about that at this stage. But if you think about outside the U.S., central banks all over the world were pursuing this exact same policy. But in many ways, they were, like in Europe's case, they were encouraging them to lend more. So the ECB had a specific policy that you could actually get cheaper financing from them if you went out and lent more to the non-financial sector. What kind of credit risk did they take? Those are going to be much harder to uncover. It's also worth noting that what brought down Credit Suisse, it was not interest rate risk. Yes, that probably played some role. It was really losses on poor lending decisions they made, which was about credit risk.
So how will this influence? I mean, we just saw from the Bank of England their decision today to increase their rate by about 1/4 percentage points to 4.25% now. And they gave even more comments on the health of the banking system. How does this continue to play a role in the decision making from central banks around the world?
Well, they're in a tough spot, right? So, we definitely have an inflation problem. I think economists as a whole and markets, you can see this from TIPS market pricing, really underestimated inflationary pressures in the system. They continue to do so, as we saw from the inflation report a week and a half ago, that actually there's still significant inflation pressures out there. In the UK, that's even more so than in the US, right? So one thing that will definitely worsen financial stability is if you let inflation get out of control and thus let risk premia start to creep into a broad array of financial assets. So they absolutely need to tackle that, but they also need to tackle the underlying banking issues. In the US, again, I think they've done it. They've used the separation principle. We're going to use regulatory forbearance and our lender of last resort facilities, but we're going to continue to go on our path to try and address inflation through higher rates. That's likely the path that European authorities are going to do. But so far, what we've seen is only that second part, not necessarily what they're going to do to support banks.
And finally, Marvin, I want to ask you about Janet Yellen, because you mentioned the stock market fell yesterday in the U.S. after Powell talked, but a lot of people were pointing the finger at Yellen, saying it was her statement that we were not going to get this blanket insurance of deposits in the U.S. that was to blame. But A, were people really expecting that was definitely going to happen? And B, if it doesn't happen, is that a big problem?
Well, I think markets definitely started to go there, right? Markets worry about how significant the broader losses in the banking system are and what deposit flight might look like at some of these regional banks. So there was this expectation there, and that's, to your point, exactly what you saw markets reacting to yesterday. That said, again, I do think the term lending facility takes care of most of that problem. I think it's also important to remember that one of the single biggest political lobbies in the United States is actually the regional banks. They are extremely powerful in Congress. So the Treasury Secretary is wisely not saying, hey, there's a blanket guarantee, go take as much risk as you want as banks. That's an irresponsible thing to do. But she is highlighting that, in fact, she actually explicitly said, Congress, you should review what deposit insurance should be. How much risk do you want to take? How much do you want to put taxpayers' money on the line?
Marvin, really interesting conversation here. Thank you so much for joining us. Hope you come back. Marvin Barth, Thematic Markets Founder. Appreciate it.